Welcome to Series 2, Episode 7 of the In Her Financial Shoes podcast. Welcome to the In Her Financial Shoes podcast with me, Catherine Morgan, founder of the Money Panel, helping you to get financially naked. Listen in each week where we talk about that taboo subject of money. Listen to brutally real life stories, step into our guest shoes and be left feeling 100% confident and in control. Oh, and we hate financial jargon, so don't expect any here. Small steps, big wins, let's go. Hi everybody, welcome back to the In Her Financial Shoes podcast. In this particular episode, I've put together just a kind of bunch of bite-sized snippets to help you to get to grips with some of the common bits of investing jargon that people often ask about when they reach out to contact me or when I'm coaching with them. Now, you've probably heard some of these terms before, you may be very familiar with them, but if you're like most people, you're probably not sure exactly what they mean. And the problem with uncertainty around anything in life is that we often then lose the confidence, we just bury our heads in the sand and then we end up doing nothing, right? And when it comes to investing, that's the last thing that we should be doing. So I'm hoping that the more comfortable you get with some of the key concepts around investing, the more empowered you will feel to maybe get started. So if you haven't already listened to some of the earlier sessions in this particular series around investing, then do pause this and go back and listen to some of them. You can get started with this one, that's absolutely fine. They're not in any particular order. But if you haven't listened to any of the other episodes, then do make sure you spend some time listening to those, because the whole concept of this particular series is that each podcast, you'll get some key takeaways from each of those. And that will provide you with the little small steps that you need to then feel empowered to just increase your confidence with either getting started or thinking about how you're already invested. So the first thing to say, I guess, with any of this is that obviously this isn't advice. This is just to give you some information to build your confidence and get you started. So let's get going. So first up, I'm going to explain exactly what the stock market is and stock market indices and what they are. So you probably hear about stock markets all the time in the news. You might see people flicking through the Financial Times on the train or on commuter flights, and you're probably wondering what the heck they're actually reading about. You know, what are they actually learning? What are they looking at when they're looking at these kind of graphs and tables and stories about them? So the first thing to say is that there is more than one stock market. There are different ones in different countries all over the world. So in the UK, we have the London Stock Exchange. In the US, for example, we have the New York Stock Exchange. In Japan, we have the Tokyo Stock Exchange, etc., etc. So there's more than one stock market, more than one stock market indice. Now, the stock market essentially is in the business of buying and selling stocks. And there are many different stock exchanges all over the world where the markets where these stocks and bonds and things are bought and sold. So a little useful or probably useless information actually, but I think it's quite interesting. The term stock, as in stock market, originated from a company that was actually called Stocks, that was owned by a man called PJ Stock, which I think is quite it's almost like a rapper name, isn't it? PJ Stock, who started selling shares to a company that didn't actually really exist. I just thought there's a little bit of useless information for you there. But it's essentially a stock market. They're in the business of buying and selling stocks. And there are other ones too. There are different indices all over the world, and you don't necessarily need to know about all of them, but just need to understand what they are. So the stock market is where companies raise money by selling off slices of their business or stocks to investors. And it's a generic term that covers a kind of collection of markets and exchanges. So if you think of the stock market as being a bit like a department store, so Debenhams would be a great example, or maybe not actually, because they're not in a great position right now. John Lewis, let's say, you can find different designers selling their stuff in different departments across different floors in John Lewis. So you might have, what have you got in John Lewis? You've got Ted Baker, you've got warehouse, you've got clothing ranges, you've got makeup ranges in there. And these designers are like the different companies who trade on the stock market, and their products are the stocks. Okay, hopefully you're still with me. So it operates on exactly the same basis. So the stock market is almost like a department store. Now, you've maybe also heard of the term stock market index. Now, the index is just a way of measuring or describing a particular section of the stock market. So going back to the department store analogy, it would be like describing the shoe section or the evening wear section or the jewelry section or maybe the accessory section. And each section sells stock from different designers. Now, you wouldn't expect the shoe section to stock every single design available in the country, but in a large store, the popularity and the success of different styles and brands will be pretty indicative of the general kind of trend. So if the market-leading shoe brands were selling out of maybe rainbow trainers, you can pretty much guarantee that rainbow trainers will be doing well all round. And this is exactly how the stock market index works. Another useless information fact for you here. So September, I don't know what time of the year you're listening to this podcast. Right now it's May, but September is usually the poorest performing month in the whole of the stock market. And that's normally blamed on the fact that people are taking vacations over the summer months, and that decreases, how often people are trading. It may be that fund managers are going off and having their summer holidays. September is the poorest performing month in the stock market. Great opportunity to be buying in, potentially. But actually talking about trends and performing months in the stock market, when the stock market prices are falling, that we refer to that as a bear market. And on the flip side of that, when the stock market prices are climbing, then it's referred to as a bull market. So you may have heard of these terms, bull and bear market. Now, there are lots of different ways to slice and dice a stock market. So mostly it's based on the company's size. And there are different indices in different countries. So in the UK, for example, the slices of those companies we have are on the FTSE 100s. So they're the top 100 companies in the UK stock market based on size. You then have what they call the FTSE 250. So that's the top 250 companies. And then we have the FTSE All Share, which is an aggregate of all of the FTSE 100 and the FTSE 250. Now, in the US, they have what they call the S&P 500 index. In Germany, they call it the DAX index. You kind of get the general gist, right? So you get, indices for different types and different styles of stock market investments. Now, another great example of another indice is ethical investing. So this is a really hot topic right now in our Facebook community, talking about how we can actually be doing good and giving back to the environment and to beliefs that we may have in, giving back to the world, etc., green energy, all of those sorts of things. And one of the ways you can do that is by investing in an ethical investment. And basically, an ethical investment meets specific either environmental, social, or governance criteria. So environmental, social, governance, ESG. So it's ESG criteria. So this means that they're not just about making money, but they're about doing this, doing good at the same time, so they can have maybe a positive impact on the environment. And you can look for ethical investments by looking at companies that are trading on the ethical indice. So in the UK, for example, we have something called the FTSE for Good index, and those are all the companies that meet that ESG criteria. We're going to do a specific podcast on ethical investing later in this series, so keep your ears peeled for that. There's a lot to talk about with ethical investing. But they take a very social, responsible approach to working with suppliers and employees and their communities, and their corporate governance means, things like executive pay and shareholder rights are properly kind of managed. So think of the indices as specialist shops rather than a general department store. So they're a great way to find something specific if you know what you're looking for. So when you go into an independent knitwear shop, for example, you'll know that you're going to find a good range of designers, but it's all going to be knitwear. And the main thing to take from this is that if indices are, they're a great way to gauge how a specific type of investment is doing. So if the index is performing well, it's a good indication that these types of companies are generally doing well across the whole of the market. Okay, so once you're comfortable with stock markets and stock market indices, the next thing I want to cover is passive and active funds. Now, we have talked a little bit about this in some previous episodes, and we've got some more coming. But just as a general rule, these are some of the differences between passive and active funds. So an active fund is a super nice, easy way to invest in companies, and a fund manager does all of the work to research the best companies to be investing in, deciding how much risk should be taken, and making sure that there's a good kind of well-diversified range of companies in that fund. And, these are like pre-packaged solutions. Now, all you do is you buy a slice of the fund with your pot of money. And when it does well, so do you, and vice versa. Now, there are two main types of funds. So you've got passive and active funds. And passive funds are also known as index funds. It's the same thing. Two bits of jargon there, just rolled up into one. Now, it's useful to bear this in mind if you're looking for these types of funds online. So when you're looking online, are they passive funds or are they active funds? And the difference pretty much comes down to what the fund aims to do. So an index or a passive fund just tracks the index. So when I referred earlier to the FTSE 100, the top 100 companies in the UK, an index fund or a passive fund just tracks the UK top 100 performing companies. You have a slice in those companies because you're invested in their performance. And that's pretty much it. It just tracks the market. So the fund is made up the same way as the index is. Now, the FTSE 100 is about 24% invested in oil and gas companies right now. And an index fund, therefore, just tracks the FTSE 100, the companies that are in the oil and gas industry. And one example of an index fund that's generally quite a cheap option, it is generally a cheap option because you haven't got a fund manager on there. You haven't got someone trying to outperform the market. They just replicate the index. They just copy it. So there's no one there actively trying to outperform what those 100 companies are doing. So I guess it's a bit like kind of carbon copies of top end designs that you find on the high street. So you won't get much change from like a top end £700 pair of Valentino shoes, but if you get a copycat pair from someone like Misguided or ASOS, it might only cost you 25 quid. And that's basically because Valentino's done all the hard design work, and then ASOS or Misguided have just kind of reproduced it at a fraction of the cost. So they're just kind of comparable there. One of the potential downsides to index funds is if you don't like what's going on with the companies in the index, then it's pretty tough, like you're stuck with it. So that's just kind of something to bear in mind, really. There's a lot of research around passive versus active and which way should you go with. Now, obviously, active funds are going to be more expensive because you've got fund managers on there that are trying to outperform passive funds. So at times they'll be very successful at doing that, and other times they won't. But you've got to pay them to do that job. And that's where the whole debate of costs comes into things, because, if you're paying away a proportion of your growth, essentially, by paying these fund managers, you want to be seeing a return for that. So that's where you may then need to look underneath the bonnet, so to speak, of, well, if you're going to go with an active fund, what's their performance like? Can they justify that extra fee that you're paying away for extra performance? And, and there's a lot to be said as well about maybe having a combination of the two. And actually, we talk about that on next week's podcast episode with Pete Matthew. Pete Matthew is the king of personal finance podcasting, and he's a firm believer in passive multi-asset investing, which we'll talk about next week. But there is a lot to be said about the differences between the costs of passive versus active. And if you're going to go with an active fund, you may want to then have a look underneath the bonnet and see what performance they have given for that extra slice of the profit you're giving away by paying extra in charges. But of course, it's not just based on performance, and you also can't measure the performance of what might happen in the future based on what's happened in the past. So, it's not a be-all and end-all of just looking at performance, but it will give you a good indication as to, whether that pay away is worth it. Now, another type of index or passive investment is what they call an ETF, an exchange traded fund, we briefly mentioned this in the podcast earlier with Melanie. So if you haven't listened to that particular one, then that will give you some information about ETFs. But ETFs essentially are another form of passive index funds. So they're structured slightly differently, but in essence, they work exactly the same, really. You just the way that you pay for them is slightly different. So ETFs are often cheaper to buy than an index fund, because if you're buying and selling them regularly, so for example, if you're saving on a regular amount every month, then they could end up costing you a little bit more, because the way that they're treated is like an individual stock on the stock market. So each time you invest money, it's like buying a new one. So it can be a little bit more expensive going into an ETF than a normal index tracker. So I guess think about active funds are, they are the opposite of index funds. So instead of tracking an index, you aim to outperform it. And the fund manager, tries to anticipate problems with companies and sell stocks before they lose any value, or they'll try and spot opportunities to buy stocks cheaply, perhaps in an undervalued company, hoping that it will, double in return, and then they'll pass that slice on to you. Now, these active funds tend to be more expensive, as I've mentioned, but there really is no right or wrong way to invest. Going with active or passive funds is entirely down to your personal preference and what's important to you. Low cost, is it low cost, or is it the possibility of better performance maybe? Now, there is a lot of research around this, and the research actually shows that over half of active UK funds do worse than FTSE All-Share type tracker funds, and that's when markets are doing well and when they're doing badly. So if we go back to the Valentino and misguided shoes analogy, Valentino is the active fund manager, and because of the high price tag and the brand, you'll probably expect that your Valentino shoes will do better. But actually, high street brands are often just as good as designers, if not better sometimes, when it comes to cost per wear. So, there is no particular data that supports active fund performance do better. And actually, in that example, there's lots of stats around that they maybe do worse. But I guess it depends on where you're reading that research, right? We have to be a little bit careful about who's producing this research, because obviously they do want to sway you one way or the other. But just have a think about that. Have a think about the differences. Maybe you want a bit of both. Maybe you start off with an active fund and maybe move to passive when you become a bit more confident, or vice versa. But I think it's just important to be aware of the differences between them. So that's kind of the last of my jargon busting snippets for now. I hope this has helped to demystify a little bit about the stock market and stock market indices. So keep listening to the series as you will continue to learn more and more about investing. And at the very least, when it comes to stock market indices and passive and active, you'll have some kind of understanding of some of the differences between them, and that will hopefully boost some confidence for you to get started, or to maybe think about where you're currently invested. Thank you so much for listening to the podcast today. And as always, if you've enjoyed listening to this particular episode or any of the other ones, then I know I harp on about this at the end of every episode, but it would really be very grateful if you could leave me a 5-star review on iTunes or Spotify, because it just helps me to get into the top 10 rankings. And the more I can get into that, the more people I can empower and educate to be financially resilient. So it would be great to get a female, personal finance podcast into the top 10. I managed to get to number 13 when I first launched, and I'd love to get kind of back up at that spot over the next few weeks. So I'd be super grateful of any reviews. So thank you so much for listening, and I will look forward to catching up with you on the podcast again next week. Take care.